welcome to our new edition of Market Makers, and these are clearly not volatile but testing times for Indian markets. You got macro scare on one side and again bang of the earnings season. So let's see how the blend of weak macro, global liquidity push and a combination of earnings season will really have an impact on Indian markets. So Jakes is back with us and he's going to walk us through where markets are headed both in the short term, medium term and the long term. So let's get the difficult part outside first. Have markets hit a bottom? Where are they headed in the short term?
I think the way I see it is between 9,800 and 10,000, where we tested last time around, will pretty much hold out. I'm sort of putting myself, out for judgment as it were. But I think between 9,800 and 10,000 is a pretty rock solid bottom. In the short run, we may even find 10,200 difficult to break. But were it to do so, I think you could find a panic bottom in the 9,800. 9,900 range.
But Jakes, Nifty has not corrected at all. In fact, Nifty for this year is still in the positive zone.
Sure.
Other emerging markets have corrected. So one would argue that abhi Nifty mein to correction chalu hi nahi hua hai.
See, the issue is not about, I think the Nifty as an index, how relevant is that for people investing? The statistics tell you that over 60% of stocks in the broad market are down below more than 60% from peak levels, from their all-time highs. If that's the case, the market, you could argue, is probably in the range of 8 to 8,500. So the fact that optically 4-5 stocks have been serious outperformers, and for a variety of reasons, I mean the entire reclassification of mutual fund investment to say the top 250 are large and mid cap stocks. So virtually all 80-85% of mutual fund flows are going only to the top 250 stocks. Means that the outperformance in a Reliance, Infosys, TCS, levers has just kept the index up. Now, some of them have corrected as well, but obviously not as much as the rest. But the interesting thing now is there are others willing to now pick up the slack in the market. For instance, I think private sector banks, which have been broadly outperformed, but ICICI Axis have been extremely weak. I think ICICI, for instance, has bottomed out pretty conclusively. And this is not to talk individual stocks, but more from an index standpoint. I think some of the cement stocks may have, despite short-term issues, may have bottomed out as well. So I think there are pockets. Pharma definitely. I mean, in fact, as a sector, definitely has bottomed out. I think pharma as a space will give you surprise upside returns. And the space that I like a lot, and more so because of recent changes in the environment, are PSU banks. I think the neglected private sector banks, ICICI Axis, SBI, Bank of Baroda, Union Bank, these I think will give you surprise upside returns because I call this the karmic cycle, and we can talk about it in terms of what has changed. So there are sectors willing to pick up the slack of outperformance, which was only restricted to 4 or 5. Those stocks may actually have corrected. Reliance hit 1350 or wherever, it's now below 1100, and in the short run there may be disappointments with the results. So I think you could have a situation where some of those which have performed well may at lower levels stabilize. I don't think they'll fall much more. Interestingly, I think the fund flow position has changed for foreign funds. I think you will have much less selling. In fact, FIIs could turn buyers through a combination of 8% plus on yields, both on the debt side and 74-75 rupees to a dollar, clearly visible now, as being factors that could bring foreign flows in. So I think foreign flows will be neutral to positive going forward. I believe that some of these sectors I talked about will take up the slack. So in index wise, I don't think 9,800 to 10,000 will really get broken in a hurry. Of course, there are sectors and sectors which are very, very positive, and the sector we should actually focus on, which I think is the big change happening, is this entire NBFC, which has been the front runner in terms of the market upsurge over the last several years. See, the NBFC space came up as a result of a considered strategy that PSUs could not take up growth in terms of durable space, the consumer durables, the growth through the housing finance books, etc. So that entire slack got taken up by PSU banks lending to NBFCs, private sector banks lending to NBFCs, and NBFCs doing what these banks couldn't do. Now with this ILFS scare and the asset liability mismatch, which RBI quite unexpectedly talks about vis-a-vis the NBFC space, what has meant is the 7:1, 8:1 leverage of these will, I think, over the next 2 years come down to 3.5, 4:1. All NBFCs today are only doing the following.
They're borrowing short and lending lot.
So that entire thing is going to change. So the entire CP maturity now between October 20th, 22nd and November 20th, November 15th actually, there's 110,000 crores of CPs coming up for maturity. Already 80,000 crores has disappeared from these short-term, through the short-term funds. Another 1,10,000 crores, out of which I think maybe 30-40% is to the really top quality HDFC, L&T kind. But the rest could be a challenge. So what's happening is these NBFCs are selling their portfolios because they've all hit single party limits. They are selling their portfolios, and where is the bank getting the money from? So the same big corporate treasuries like Reliance, Vedanta, ITC, Maruti, etc. are now pulling money out of these mutual funds and putting them in bank deposits. Those bank deposits act as the sort of long-term source, if you will, for banks to reposition themselves of buying these assets off. So from an NBFC perspective, the assets come off, the liability also comes off. So overall leverage is going to reduce. They're not going to get more access to direct lending. So their growth is a big issue. So the NBFC re-rating has actually built or de-rating has built this in completely. So with the NBFC space coming off, PSU banks taking the thing, the portfolios, I think in the short run, portfolios of almost 2 lakh crores will get sold off in the next 6 months.
So banks will end up buying all the good assets of NBFCs?
So the NBFCs may end up with a portfolio which could be quote unquote a little less liquid or a little...
it's a time bomb in making, Jakes, isn't it? Then after 2 years when the bad loan...
So the NBFCs, but the NBFCs, what will they do in the interim? They will go in for more equity issuances. Maybe the equity market is only at 1.5 times book, so be it. They will go in for long-term bonds, and that's when the repositioning happens. But that takes 2-3 years. So the NBFC is in a consolidation and long-term fund generation mode for the next 2-3 years. Growth is not their principal objective. From a bank perspective, in fact, the question that could be asked is, do SBI, BOB and others, do they have adequate capital to absorb all this? So I think that's the thing. So the big shift in portfolios happening, and the private sector banks that are well capitalized may actually be able to take up this. So that's why I'm so bullish on the ICICIs, the Accesses, because they could actually be beneficiaries of this portfolio which these guys have created over a 5-7 year period.
So the wheel essentially of lending is going to change. I mean, what banks lost, NBFCs gain, now NBFCs will lose and banks will gain.
That is absolutely correct. And there's one more thing that's happening. NBFC business model itself has come up for some kind of questioning, and therefore the liquidity that the NBFCs supply to people like the stock market, LAS, etc. could also be a bit under the cloud, as it were.
Okay, just one more follow-up question on NBFCs and then we'll move on to other sectors. There was a scare in the market earlier this week that NBFCs have given loan to builders. The loan against property is somewhere they will be in challenge, and a huge mismatch could be coming up because real estate is in a dire state, so to speak, and builders may start going belly up because the cycle is not reversing. Do you think understanding a book of a large NBFC is like peeling an onion? You keep on peeling layer after layer, or it's not that bad?
I don't think it's that bad. I think the reality is that the realty space is in trouble. There is no question about it. I mean, you can see unsold inventory across the board. The reality also is that a lot of these NBFCs had outstandings to the realty companies against specified assets. But if those companies went into NCLT, these assets get pooled, and then your outstanding actually becomes a bit of a question mark. And I think so far the question of realty companies going belly up was not there. It's a reality today. And the truth also is that if liquidity is going to get crunched, what happened in the US in 2008? Banks got refinanced. What did banks do? They took the money but didn't onward transmit it, because the credit to they essentially put back in government securities and T-bills, but they stayed on liquidity. A similar psychosis is sort of developing right now. Banks are getting the liquidity but really are not lending to anybody other than the top few names, which means that credit as a whole in the economy is going to get crunched. Consumption is going to come under, I think, a severe pressure in the second half of this year.
That's discretionary and non-discretionary both.
Absolutely.
So autos,
I think durables,
everything.
I think they will, because banks have not shown the ability or the adeptness to put on assets by going out and marketing. They're just buying portfolios, right? Once that is done, they're not out there trying to build up a much larger portfolio by going to the... So the incremental credit to the economy, I think, is going to be under a big threat. And that means affecting GDP. And this is a run-up, by the way, into the election. So I think somewhere in the government needs to understand that today liquidity is the mother's milk of sentiment. If you don't have liquidity, there is no sentiment. So into the elections, whatever the government might do, the NBFC space, I repeat, can't be wished away. You know, all these measures that RBI talks about, incremental single party limit, etc., needs to have been announced on day 1, not on day 15, day 20. I mean, 15 days is too long in the financial services space. You need to actually go out there. When the Lehman crisis happened, when Bear Stearns happened, these decisions got taken on a Friday night, Saturday morning, before markets open on a Monday. They are not, held in abeyance and allowed the sentiment to drift over a 2-week period. This is the problem. So today, ultimately, I mean, in the long run, I don't know the adjustment happens, but in the short run, you don't want another ILFS situation. So I keep saying, an ILFS is not representative of the NBFC space. It was actually an infrastructure holding company. It's got nothing to do with being an NBFC. In fact, the NBFC in ILFS is below the main company, which is the core investment company. The problem is, if you squeeze liquidity in a fast-growing space like NBFC, you may create an ILFS kind of situation.
It has to be dealt.
It has to be immediate and surgical.
It's too big to fall. It's not like a Mama's Club and 10 ladies have come together and started a chit fund.
That's correct.
So structurally, NBFC space needs to be protected.
And not just protected, it's actually a systemic issue. I don't think we can overemphasize this point. Nothing can be overemphasized. The fact that liquidity is the principal thing that was driving it up. They were growing at 20, 30, 35%. Where was that coming from? They had 8:1 leverage, 9:1, and they were trying to build long-term funds over a period of time. You can't, through one ALM statement, throw the cat amongst the pigeons here, and which is essentially what you've done.
Now, last time when we met, I guess, or not last time, I guess 2 quarters ago when we met, you were quite gung-ho on aviation, and your view was that, look, the bad news in aviation is a time to buy. But bad has got worse. Is this only because of crude?
It's got worse because of 2 reasons. One is because of crude, and 2 is that pricing to passengers has not kept pace.
Why is that?
I think it's just an obsession that some of the main, in fact, the principal, the top 2-3 companies have with load factors. I think load factors need to drop to sensible levels of 75, 80, 82% and make passengers pay for what is a fair, because now it's become...
It's an experience. Flying is an experience.
And it's become now something that is a preferred mode of travel for most people. Rather than saying, use train travel or bus, people are saying that, flying is convenient, there is a value for the time and you're willing to pay for it. Now, if you keep saying no, but the marginal ticket will go at 750 rupees, I mean, we've gone through this, right? 2,500 rupees to fly Bombay, Delhi. I mean, with crude at 80 and dollar rupee at 74, I mean, what kind of sense does this make? And it's not that these companies are being spearheaded by, people who don't understand this. They're making cash losses on a daily basis and continuing to do it. So that's that. But I think what this is going to lead is, this is going to lead to consolidation. There's definitely going to be issues of, it's like the 10 little niggers kind of thing, and then there were 9 and then there were 8. So I think they're going to be either entry of new players. The good news from a silver lining perspective is while the consolidation is happening, pricing power can return. But more importantly, I think crude may have peaked out, in my opinion, at 86, 87. We could be on the way down. China's growth is slowing, world growth is slowing. Other than the US, which is on its, on steroids in a manner of speaking, every other economy, there are pressures. India will slow down next quarter. So I think crude will come off if it's fundamentally linked. But a lot of crude price movement, I've always maintained, has not been fundamental, but it's been a play on the markets. Other issues like Saudi, geopolitical, going public of Saudi Aramco, etc. So but in the short run, I think the tailwinds that were there for crude price movements has actually become, I think short term has become headwinds.
Suddenly HPCL, BPCL, OMCs are available in and around their replacement cost. These are businesses which cannot be replicated, and these are businesses which have a genuine and a natural moat around them. Would you buy this decline in OMCs? Because crude, if your view is crude is bearish, maybe there's a trade there.
I don't think so. There may be a tactical trade if you're lucky, because really speaking, I think one is not able to take a call on whether the government will keep interfering, especially as the election year and the spectre of the elections approaches. It is not impossible for the government to take decisions which affect 3 companies but benefit the economy as a whole, like the recent decision. So I don't want to get into whether it was desirable, not desirable, and whether it will repeat again. But the fact that event risks around the oil companies makes it clear that they can't be permanent portfolio additions. They can be tactical plays, they fall off 30-40% on movements like this, and then you could take a play and make 20-30%, possible. I'm not, unfortunately, that smart to sort of figure out what's a bottom and what's not. But I think there are fundamental issues of government policy level interventions that could make for business dynamics that could get disrupted. So I wouldn't recommend those.
Now, a year from now, we would have, a year from now, let's say 2019 or October 2019, a lot would have changed. Interest rates globally would have changed. We would have a new government or perhaps continuation of the current government, but the election risk would have been behind us. So do you think right now this market is giving you more like a Flipkart and Amazon sale that you can grab before markets really, get their rhythm back?
There are always 2 sales in a year in the stock market in India for several years. Sometimes the bull market gets extended, the sales happen once in 2 years or twice in 3 years kind of thing. But the reality is today there is a complete, every other factor, but most importantly, the fact that liquidity, the financing of mid-cap stocks, etc. has been completely decimated. The market is telling you what values can go down to when there is no liquidity in the system. And that is a time when you have liquidity, you will make a killing. So
this is not a bear market. This is not like the beginning of a bear market and what has fallen could fall more.
I think the fact is most of the, if 60% fall is not constituting a bear market, I don't know what is. So the funny dichotomy here is that the broad market is actually extremely oversold and in a fundamentally bear market, because the price have just gone completely, nothing close to reality. But the index doesn't tell you any such story. So is this dichotomy something you can, so I think the idea is to leave the index out, look at fundamental bottom-up stock picking, and I think you'll find that the baby and the bathwater have been thrown out together. So it's possible to generate a lot of alpha by looking at stock specific.
Okay, so I'll take that point slightly forward. Ignore the index, but look at small and mid cap stocks, and that is what any investor should do.
Right.
But the charm of mid and small cap stocks, some would argue, is already over, because liquidity will not come back in a hurry there.
But businesses that earn, ultimately cash flows will and valuations will hold. So in the short run, you will be getting things at 3 times EV EBITDA or 2 times EV EBITDA. It's not going to stay. So I think businesses that survive this, and there are plenty of businesses, will actually give you the same. Markets have a short memory space. Tomorrow, if FI flows reverse, your liquidity is back. They will obviously not just stay only in the frontliners, but also expand their scope of purchase. And if that happens, why should you believe that some of these mid-cap stocks can't double and treble from here and still be 20-30% off their peaks?
The bears are insisting that, guys, emerging markets have fallen, developed markets have not fallen yet. The leadership in FANG stocks is just getting shaken up, and they can come down a long way, because in US we've had a 10-year bull market, which is the longest after World War II. We both know that data. But is there merit in considering that US markets, when they start correcting, it's just going to add more downside here?
I would say, in fact, the other way around. I think I keep going back to this. The broad market has corrected. Make no mistake about it. Stocks have fallen 60, 70, 80%. Whether that constitutes a bear market move or a bull market correction of a high order is semantics. The reality is there are multiple stocks that are down 60, 70, 80%. And I think you need to take a look at those and evaluate them for what they are. If that business is going to die, it's a different story. But if those companies are going to continue producing numbers, maybe growth slows down. But I dare say many of them which are quoting at 12 and 15 times EV/EBITDA multiples are now at between 3 and 5. And the reversion to mean back to an 8-10 will happen. So I have no doubt that the fact that money making in a sense had become easy over the last several years, because you could literally put money, people will tell you stories of Bajaj Finance, etc., etc. The reality is that money making is never meant to be that easy, where people just forgot everything else, left industry and came back and put money and assumed that the portfolio will grow. You're not preordained. The market doesn't owe anything to you to continue growing your portfolio. So I think the first takeaway is, if your portfolio has fallen less than the broad market, and I say broad market as in the stocks as a whole, I think it's one way to then stress test your portfolio. The other way is to say, let me put in some money, which is maybe smaller quantities I hold, but for longer periods of time, and let me try and generate returns through that. I don't believe that in any manner you're going to get a dartboard competition where literally you throw anything and then you're going to have a stock up 30 or 50%. I think those days are over, and you will have stocks in your portfolio that get crushed and those that will outperform. But as a whole, you need to be a stock picker today.
Currently the narrative is centered around liquidity.
Sure.
From 6 weeks, it will be centered around state elections. and bulk of the narrative next year would be centered around general elections.
Sure.
I've looked at the history of elections. Markets remain curious, but markets don't get nervous in the run-up to the election. So you think we should just ignore all the noise, all the opinions, whatever buzz is there on the street from a market standpoint? Yes, elections are crucial, they are important, but purely from a performance standpoint, it's going to be history repeating itself once again.
Okay, let's put it differently. Let's say you know these factors. What are you going to do? Are you going to sell down your portfolio and walk away?
Ideally, you should not.
Right? And history tells you that when uncertainty is there on the horizon, markets may react. But at the end of the day, the market wisdom is already there in the prices. If you explain
that's the nature of the beast. It's a forward-looking
mechanism. I think a lot has already happened. So if you believe that the markets are now suddenly going to say, hey, you know what? Now liquidity is getting tight. The moves in NBFCs, 50, 60, 70%, and not moving up from these levels indicates that the market is sensing something much, much worse than what we've all put together. So at one level, I'd actually argue that much more than we are aware of is being built into the price. But because prices are as attractive as they are, I believe that we should be out there shopping.
But Jix, you're not a trader, so you will not go short.
Sure.
But other way of having a bearish view is that you raise your cash levels.
Yeah.
Are you fully committed to this market? Are you finding enough opportunity? Like a common friend, Mr. Rakesh Junjwal, always says that in India you can find a buffet. There's so many things which you can buy.
So in a market like this, you'll always find your cash short. From a personal perspective, I'm about 30% in cash.
Why is that?
Because I always keep between 15 and 20% in any case. I'm never 100% invested. So 15 to 20% I've always been in cash. I've raised that to 30%. And I think in the next 3-6 months, I'll probably come down to only a 10% level because I will be redeploying all of this because I think the opportunities are huge. The one thing that we need to see is the impact of liquidity affecting businesses is not very clear in the first week of that. So as we meet more managements in the NBFC and other space, the transmission of credit is just not happening. Banks are getting refinanced, banks will get the liquidity. How does that move to an intermediate lender like the NBFC and a final consumer is not very clear. And as I see it right now, I can't see that transmission taking place. So I am nervous only from that perspective. But when I see prices, I get the feeling a lot of it is baked in.
Okay, so let's get closing
Sure.
comments. We spoke about the benefits of index investing a couple of quarters
Sure.
ago, and that is the way how world
And
is
it's,
moving,
and it's played out, right?
You just said that ignore the index right now. What are you trying to imply?
I said for those who are not in the market, passive investing by putting money in the index would have actually benefited because a lot of changes that took place which we are not even aware of in terms of mutual fund classification, etc., actually has helped. And it is not that I was prescient, but I just felt that a passive investment strategy at that time was making sense because markets were running away. At which point in time, individual investors are better served not putting money into individual stocks which they had no idea about, but better done through the index. Today, the way I see it is, I think you may want to expand that to say some mid-cap portfolios, some diversified, and that's the way moving forward. And maybe even put some money into debt funds because I think debt returns of these levels cannot sustain. I think a lot of foreign money will come into capture, 74 rupees to $1 and 8+ on the long bond.
Wonderful to have you back on.
Thank you.
Thank you for
so
joining
much.
us. Thank you for watching this edition of Market Makers.